So what is fixed income market, right? First, you need to understand this name, fixed income. Now, fixed income, by as the name suggests, is a instrument. Fixed income instrument rather is an instrument which gives you a fixed income. That's as the word suggests. For example, if you do an equity or a stock trade, you're not sure of what will be the return on the stock, right? Because the stock price can go up and down. Whereas a fixed income instrument is supposed to give you a consistent income. That means you're supposed to know what will be the outcome in terms of cash flows from that particular instrument. That's why it's called a fixed income instrument, right? Now, primarily, because we're talking about financial markets, right? You can think that most of the fixed income securities or fixed income instruments are typically of the nature of debt instruments. Most of them. I'm not saying everything is a debt instrument, but generally fixed income instruments have some element of debt involved in it, right? So a fixed income, therefore, instrument is almost like a debt instrument. Think of it like that. Now, fixed income market is a global market, right? It is traded across different countries in different time zones. So each country has its own fixed income market, right? Again, the market is a very big umbrella term. Fixed income market consists typically of both bond market and non-bond market also. But we will focus more on bond market here. Bond market and money market. That's one way of looking at fixed income market. I mean, this is not like the only classification you can make, right? Bond market is a market where people buy and sell securities of typically, greater than 1 year maturity. Generally, that's what the name is, bond. In the market, bond is typically used for greater than 1 year expiry kind of a instrument, right? Money market, on the other hand, is a market where instruments and borrowing lending less than 1 year maturity are traded, right? That is money market. So this is one classification which is important, bond market and money market. Now, again, what is a bond and so on and so forth, we'll discuss, of course, in more detail now. But within bond market, and even for that matter, money market also, who are the participants, right? Basically, you have countries, right? Countries participating, right? The governments. And those kinds of instruments are called sovereign instruments. Sovereign instruments are where governments are involved, right? Then other kind of instruments are available, which is quasi-sovereign. Now, quasi-sovereign are typically quasi-sovereign instruments are those where almost like a government, semi-government kind of entities are there, are participating, right? Are involved. For example, in the US market, there are these housing finance agency companies like Fannie Mae, Freddie Mac. These are government, almost like a government agencies, and they issue some instruments, bonds, and they're traded in the market, and they are quasi-government instruments. Similarly, in India, for example, PSUs, which are almost like government, like for example, REC, Regional Electrification Corporation, right? Power Finance Corporation. These are PFCUs, but they're almost like governments, right? So they issue bonds. They're called quasi-government bonds. Similarly, NABARD in India is Agricultural Development Bank, right? NABARD also can issue some bonds, right? And they are quasi-sovereign. Then in addition to that, local government bonds are also traded, right? Local government bonds meaning local government, typically you can have a state government, you can have a municipalities, and so on and so forth, right? So these are also typically government, but they are not central governments, right? They are also participants in this market. So local government. Then of course you have corporate elements. For example, banks and companies. Even bank can issue some paper, some instruments. Companies can also issue some instruments, right? The bond instruments and so on and so forth. So these are called corporate bonds. Corporate meaning companies. And of course, finally, supranational. Supranational meaning they're not really national, but they're actually more like international, so to say. For example, Asian Development Bank is not a bank of any given country. it's a development bank set up by a lot of countries coming together, right? Similarly, you have IMF, World Bank. These are all supranational organizations, right? So they issue some bonds in the market. They are also traded in the market. So these are all the entities that are available, right? So when somebody says bond is a generic instrument, but who is issuing the bond? Depending on that, the market is separate. Now, this is the bond. Again, most of these players are primarily in the bond market, but they're also in the money market. I have put in their participation primarily under the bond segment, but it doesn't mean that they're not in money market. Of course, they're also in money market, but primarily they are into bond market. Typically, their presence is more in the bond market, which is greater than 1 year. Now, money market less than 1 year means that the instruments that are traded are of maturity less than 1 year in this market. Now, specifically, one of the instruments which is very important, especially for banks, is what is a repo, right? Repo is a very common instrument in money market. Repo is actually repurchase agreement. That is a short form, repurchase agreement. Now, repurchase agreement is basically short formed as repo, right? Repo is we'll discuss repos in much more detail in the later sessions, but repo is one instrument like that. And then in the money market, there are banks which are borrowing and lending to each other, right? They're doing deposits. We discussed deposits in the previous sessions when we talked about FX also. So interbank deposits. So they are also part of money market, less than 1 year typically. And even, of course, I have not written government here. Even governments, for example, also are part of the money market where they borrow for less than 1 year. All right. Then that's what they're called short-term bonds. Typically, short-term bonds are also money market instruments, right? Short-term meaning less than 1 year. So short-term bonds issued by either governments or private companies and so on, and banks. So they're all part of the money market instruments. So net, fixed income market can be divided into two parts. The reason why I divided based on the tenor is because the way the instruments are structured, the way the pricing happens, they are very different between bond market and money market. Right? There are some subtle differences which are important, and that's why I divided them into two parts. Right? But at the core of it is the instrument which is like a fixed income instrument. Right? Now, of course, this is on the bond side of it. Bond side meaning where people borrow money using bonds as instruments. Now, in addition to this, as the kind of instruments that are traded in the market, there are a lot of terminologies that are used. So each of these instruments we'll discuss in the coming sessions in much more detail. So there is something called a commercial paper and CD. CD meaning certificate of deposit, right? So commercial paper and certificate of deposit basically are short-term instruments in money market. Okay, I'm just giving a flavor of it right now. We'll delve much deeper into them at a later point in time. So CDs, commercial market, are typically they are part of this is part of money market, MM, right? Then bills, bonds, and debentures. Again, these are all various types of bonds. What is a bond? What is a debenture? We'll once we complete the discussion on the bond, we'll come back to these terminologies. Then there is another market called a derivative market, right? Now, these are instruments which are suppose they're classed separately as derivatives. So I'm not getting into them right now. There are sessions for derivatives in detail much later, but derivative instruments are also part of fixed income. So instruments which are dependent on interest rates, yield, derivatives as they're called, they're also part of fixed income market. Then there is a process called securitization, right? Now, what is securitization? Again, we'll discuss in when we talk about credit and derivatives. But securitization is a form of converting lot of loans into traded instruments in the market. So for example, you have a lot of student loans in the US. You have a lot of credit card debt in the US, right? So some banks and institutions, they combine a lot of these loans put together and using the cash flows from those loans create a instrument like a bond or something like that, which can be then priced and traded in the market. That process is what is called securitization. So securitization is also part of fixed income market, right? Then there is something called a credit spread, right? We'll talk about it when we talk about corporate bonds. There is a credit spread, right? The interest rates applicable to a corporate when they borrow in the market versus interest rate applicable to a government when they borrow in the market, there's a difference. So the difference is what is credit spread. We'll discuss credit spreads later. So this credit spreads, and then there is a lot of derivative on that. There are derivative instruments also on that. That is also part of fixed income, right? And finally, in addition to all of these instruments, there are mutual funds, there are exchange traded funds, whose job is to invest in some of these. For example, in India, you have a liquid fund. Now, liquid fund is a mutual fund where you put in money, they pool all the money, and they invest that money in a set of very short-term instruments, which basically give low interest rate, but they invest in a very short-term instruments which can be immediately recovered. The liquidity has to be maintained. That the need for immediate cash is important in liquid fund, right? So liquid funds are an example of money market fund. Money market because they invest in less than 1 year securities. So there are a lot of funds like this. There are exchange traded funds are also there in the US. India, not money ETFs are there on the money market, on the bond market side, but in US and other developed economies, developed markets, there are a lot of exchange traded funds where they trade on an exchange, like a stock exchange, like similar to that. You can buy those instruments, funds, and they in turn reflect the prices of their underlying other instruments, right? So these are exchange traded funds. So ETFs, funds, they're also part of fixed income market, right? So fixed income market is a very, very big sort of umbrella term which has a lot of instruments in it. So to understand fixed income market in full detail will require long and lot of sessions. It's not going to happen in a session or two, but the idea here is to introduce some of these instruments and cover more of these in the later sessions in much more detail, right? So at this stage, we are going to focus on the surface level and introduce you to some of these instruments, and then we will come back in much more detail later. That's the idea. So bear with us in this aspect. Now, so therefore, just to summarize this slide, what we need to understand here is very simple. What is a bond, and what is the difference between instruments in the money market and the bond market, right? That is the agenda for us. Now, the type of bond is obviously dependent on who is basically involved. Be it a sovereign bond, quasi-sovereign bond, local bond, corporate bond, supranational bond, and so on and so forth, right? And then there are short-term bonds, and they are the name that are given to short-term bonds is what are called bills. Bills are basically short-term bonds, less than 1 year, right? Bills. So these are all the instruments that there are.